Thank you. Good morning, everyone. I'm Tracy McKibben. I'm the chair of the Finance and Risk Committee of the Authority and the New York State Canal Corporation. I'd like to welcome my fellow committee members, Chairman John Comel, Dennis Traynor, Betheda Gonzalez, and Anthony Pacenti. Michael Balboni has been excused from today's meeting. Welcome to all of the NYPA and Canal staff that's participating both here in person as well as virtually. This meeting has been duly noticed as required by the Open Meetings Law, and I call this meeting to order. All of the committee members have had a chance to review the agenda for today. I'll ask if there are any questions or additions or amendments to the agenda. There being none, I'll ask for a motion to adopt the agenda.
So moved.
Second.
Okay. Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thank you. The agenda is adopted. The next portion of this meeting will be held in executive session. I'll ask for a motion to conduct an executive session to discuss the financial and credit history of a particular corporation pursuant to Section 105 of the Public Officers Law.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. We'll be back shortly. Thank you. Thank you. Welcome back. I'll ask for a motion to resume the meeting in open session.
So moved.
Second.
Can I get a second? Moved and seconded. All in favor, say aye.
Aye.
Any opposed? Motion carries. Thank you. No votes were taken during the executive session. The members, committee members were all polled prior to the meeting regarding conflicts and have submitted all potential conflicts to the corporate secretary for inclusion in the minutes. We'll jump right into our discussion agenda. And first up, we will have, and I'd like to invite Earl, Director of Market and Commodities Risk, and Brian, Director of Market Analysis and Hedging, to present an update. Earl and Brian are virtual. There they are. Okay.
Good morning, trustees. My name is Earl Tamagi. I'm the Senior Director of Market and Commodities Risk, and as part of governance on the merchant energy portfolio, Commercial Ops presents a strategy to the Enterprise Risk and Resilience Management Committee, which risk management provides analysis and concurrence. As part of governance and transparency, Brian Chan will be reporting out to the trustees regarding details of the program that was just approved this past month. Brian, I turn it over to you.
All right, thank you, Earl. So let me just take this opportunity to thank everyone for their time and opportunity to present today. Again, for the sake of introductions, my name is Brian Chan. I'm the Director of Market Analysis and Hedging, and I'm here presenting on behalf of the ERM and Commercial Ops team today with a quick informational update on the hedging program, which was originally delegated to the authority via the October 29, 2002 trustee memo. So now, as a general reminder, the hedging program was established as a tool to mitigate energy market price volatility. And in 2020, we did establish a multi-year hedging strategy, where we layer in hedges over a period of time, very similar to the dollar cost averaging strategy. And what this means is we're financially protecting our merchant portfolio at regular intervals, regardless of price, over the course of 3 years, as to line up with the NYPA budget setting process. Now, we do recognize that the forecast and market conditions continue to change, but the guiding principle behind this program is risk reduction for the merchant gross margin revenues to provide budget stability. Next slide, please. So here we have a slide which I hope is very familiar with folks, as I have shared this a few times in the past. It's a conceptual graph summarizing the scenario of the market movements over an extended course of time. So each of these commodity cycles represent a period in which the market has gone through a peak and a trough. And just like the real commodities market, there is no predefined timeline for when this occurs. The blue line represents the average dollar per megawatt over the course of time. And if our portfolio remained unhedged, the valuation of the NYPA portfolio would kind of follow this curve. And what you see is these big up and down swings, which represent price volatility. The larger the swing, the larger the volatility. Now, without the ability to know exactly when these movements occur, it presents a very large challenge from a finance budgeting perspective. So the goal here is to flatten that blue line to create that orange line that you see going across the graph. And this is where the hedging program steps in. ERM steps in to execute these transactions at fixed prices to create a flatter line that you see here. So we look back, what you'll see is the differences between the unhedged and the hedged portfolio. And so in a rising market, which we did experience this year, what you end up doing is giving up some of the upside opportunity. However, in the declining market, what you'll be doing is the hedges will provide that protection. It'll mitigate, but not eliminate all that downside risk. Again, without the ability to time the market, it's very important to remember that we stay the course once a strategy has been set to stabilize revenue and to minimize downside risk. Next slide, please. So now with that said, this year we
Brian,
have,
sorry, before we go on, can I,
of course,
Brian, one quick
Yes.
question that I had on the previous
Yes.
slide, and just
Yes.
making sure I understand, I know we're hedging against energy prices, and that we're just talking about, it's primarily gas, right? And so in your mind, as you think about where we come out in a positive direction, generally, we need those prices to be around where, when you think about our hedging strategy that we've put in place?
so let me just one statement. So yes, gas does drive it. However, we are hedging against the energy prices, right? Because we're trying to manage both the hydro units as well as the fossil units. Now, in terms of the pricing, where we set our strategy is always relative to budget setting time. So we're setting the volumetric hedging in order to basically hit these targets. However, again, in a market where the market is turning down, this is where the strategy kicks in, because irregardless of price, we're going to continue hedging so that over the course of time, it averages out. Does that make sense?
Trace, Trustee McGibbon, is your question about what's the minimum, like our marginal cost of production?
Yeah.
So do you want to, what I can say is that, the way that we look at our hydros, you can look at our cost plus tariff structure there, where, we're looking at covering, our minimum generation. You could say that is roughly around like $15, right, from our hydros. And then our gas units, we bid and look to acquire and purchase gas on a day ahead basis. So we incorporate the cost of the gas into the bidding that we put into the market. So if the gas price is higher, that's our margin. It feeds into our marginal cost of production, and then we will bid only an amount that incorporates that. Obviously, we have ongoing fixed costs in O&M, but really the major driver in the price that we would bid into the market for our gas units, our fossil units, is what the gas price is.
Right, and our hedging strategy around that is
Yeah, our hedge, the majority of our portfolio, is hydro, and the gas units, are also in there. We do,
all right.
yeah.
I get it. I got it. Okay, all right, thanks.
And sorry, can I just one quick clarity comment? I think what Sarah mentioned was correct, and that's more on the day-to-day basis, whereas we're looking long-term, trying to stabilize the long-term view. But yes, I think everything Sarah said is 100% correct.
Thank you.
Yep. Okay, so now again, with all that said, just to go over kind of what we went through this year. This year we have experienced a rising market, which recently has kind of leveled out a little bit, but again, we're still experiencing high prices. What we were able to do this year, using the team's prior year's experiences as well as commercial acumen, is to capitalize on this year's elevated market prices by hedging ahead of schedule. Another key highlight this year is associated with our daily market communications with counterparties and brokers. While we still continue to communicate daily, counterparties are now reaching out to us for deals, which has and will lead to some new opportunities in the future, however large or small. So this is a step in the right direction for the program as we'll continue to develop it. So the slides in front of you also have two more familiar stats for the committee, which I shared last year. The first stat here on the left is the trade execution, which is a trade count chart. As a reminder, the program started in 2020, highlighting the dollar cost averaging strategy. And obviously, because it was implemented, the year it was implemented, you'll see the large trade count. However, in 21 and 22, you'll see it stabilize. One particular thing I would like to highlight is that since inception, we have actively steered away our trading away from the exchanges and towards the OTC market to avoid added brokerage costs as well as margin requirements to benefit NYPA. And that's represented by the green bar that you kind of see shrink over the course of time. Now, the second table reiterates the effectiveness of the program. The second table represents the downside risk profile of the portfolio relative to the merchant gross margin targets. So what you have here, the green bar represents our current state with hedges, and the blue bar represents our what-if scenario of no hedges. And what you want to see here is the continuing shrinkage of the green bar, which you do show here. It doesn't shrink as much over the course of time, again, because of the strategy, which is we're layering it over the course of time. So the biggest impact always is the prompt year as we're going into the year. Next slide, please. So now moving forward, as Earl has mentioned earlier, we have presented and received ERRMC approval for our 2023 strategy going forward. Attached is the highlighted updates to the volumetric multi-year market rich hedging strategy. Key takeaways is that we are decreasing and speeding up the percentages and the target date in order to reassess the portfolio at an earlier stage. In this case, it'll be June, to continue our disciplined approach to stabilizing portfolio. As stated earlier, communication with counterparts has been critical, but just as critical, it will be our increased communication and collaboration with our internal partners in risk, finance, and accounting. Any substantial changes will be communicated to the ERRMC throughout the year. And I'll close by reaffirming the fundamental success and continuation, as well as ongoing improvements of the hedging program and strategy. With that said, let me pass it off to my counterpart, Earl, in the risk department to go over the governance. Thank you.
So one more question that I had for you, Brian, before you pass it on is, I see the reduction in our hedging strategy. What's the assumption behind that? Is that because you expect less volatility, which is the whole reason why, right, we initiated our hedging strategy? Yeah. Is that the assumption behind the reduction, or is there another reason why?
So there are multiple
You've
reasons.
Concluded you'll need to do less of it.
Sorry.
Sorry. Go ahead.
Oh, sorry. Yeah. So there's a couple underlying reasons. One of the driving reasons is to manage some of the water flow, which has been reducing, and the assumption is with water flow decreasing over the course, always returning to the long-term average. There is still some reduction in volumes, and we would like to avoid having to buy back, which is an added cost for NYPA. And so what we're doing is by lowering the percentage, we can manage that, but at the same time, by speeding it up, we'll have an opportunity to reassess the whole portfolio come June. And if with the information that's available at that later point in time, we could always go back up to 65%.
We'll change it. Okay.
Depending on the current status at the time.
And just to be clear, it's a minimum percentage, right?
Yes.
So we're always looking at accelerating it if the market conditions have that, but it's to manage the fact that we're looking at energy price risk and volume risk, and it's to better manage the volumetric risk.
Right. Thank you.
Yeah, and from a program perspective, I think we do want to be more conservative. And again, with more information, we can make better decisions going forward. Do you have any other questions?
I don't. Any other committee members have questions? All right. You want to close out the last slide?
Sorry. I guess, Earl, this is where I guess you want to go to the next slide.
If you could go to the next slide, please.
Yep, there you go.
You know, as Brian mentioned, the risk management team looks at the hedge strategy to see if it's going to meet the goals of greater revenue in out years. To your question, Chair McKibben, about the targets having a pivot, and what Sarah had mentioned is that rather than achieving the goal in August, we actually moved back achieving the target a few months in June to be able to give us a checkpoint as a milestone in order to see if we need further hedging for the portfolio. As commercial operations begins to execute their activities, my team actually then jumps in and takes a look at the portfolio on a daily basis, independently looking at the value of the assets, how much revenue we'll be bringing, and we continually assess the effectiveness of the instruments that they're using to see if the relationship between the products and the market risks are actually still there, to see if there's a correlation and risks are being mitigated. A key point that I'd like to point out is that the current activities that we've been monitoring for are within the approved strategy and are in conformance with the current prescribed guardrails of the program, including transaction limits and tenor of up to 4 years. As Brian mentioned regarding the counterparties, we'd also like to note that in order to protect the authority, we've limited all transactions to only quality counterparties where we currently have no exposure to non-rated and or non-investment grade counterparties at this time. And we plan on continuing that to only leverage the authority's credit rating and use quality counterparties. With that said, Brian and I are open for questions.
Yeah, just since you closed on counterparties, one question that I had is, and maybe when do you come back to us? Is it after you do your review in June? When's the next time we will have a discussion around hedging? Because I do think it will be important to always let us see who our counterparties are. You know, I know you're looking at them on a regular basis, but it would be good for the committee to be able to see. And I don't know if there have been changes made in the last, over the last year. Again, consistent with,
Yep.
as you said, the commitment for investment grade and all of that, but just being able to see them.
Sure, and we can send that in between, we can send that as an information out to the trustees and particularly for you to show you who the current counterparties are, their ratings, any exposures that
Exactly.
may have. One of the things, Earl's mentioning is that we were trying to, for liquidity purposes, trying to avoid having to post a lot of cash collateral at the exchange. So we've been working with counterparties to get an unsecured credit limit from them and expand the number of counterparties we can trade with so that we can, maximize our trading ability. So we'll provide a full list of who we currently have exposures to today.
Great, thank you. Any other questions from the committee? All right, thank you. No vote is necessary. Adam, over to you.
Sure. Good morning, trustees, NYPA colleagues, members of the public. Just want to briefly update on where we stand this year through actuals, our 9+3 forecast. And this is the basis of setting our preliminary budget. So we'll go from the actuals to the forecast and roll into the preliminary budget. And then between this meeting and the full board meeting in December, there'll be deliberations, briefings, discussions. If any changes are made, it'll be made at that full board meeting. Next slide, please, Carly. So as we've been reporting in the past through the first 9 months of the year, we've earned $108 million against a target of $41 million, exceeding that target, while expenses have mainly tracked according to budget overall, with the exception of, say, the monetized funds, which is a result of increased tariff revenues for certain customer regions where those monies will then be deposited into an account, and for the benefit of those entities, it shows up as an expense here as well as in the revenues. But really, the results are being driven by improved and increased energy prices, which have come down slightly in the last few months, as well as increased transmission revenues from what was originally planned in the budget based on the latest revenue filing for the transmission revenues, as well as fax revenues, which is a result of congestion in the system. Please go to the next slide. The forecast at the end of the year is in a range of 110 million to 135 million. Right now, we say the expected is in 118 million. And, we see that most likely being the case, but it could go, up or down slightly, but mostly, if anything, I would say the risk is probably more to the upside, given where we are today. Next slide. So that's the basis of projecting the, or setting the stage for the 4-year plan. And as I mentioned, energy prices are higher. Expected transmission revenues are projected to be higher. Those are the driving forces. Next slide, please, Carly. As we move into the plan, go to next.
So before we go, one question that I had, when you're looking at expenses, do you have a division in your mind of what is from, timing, moving things into the, whether next quarter or next calendar year, or efficiency initiatives? Do you have a divide? Because you did better on the expense front, and how would you divide that up? How much is it from efforts that you made as opposed to just timing of when things came?
Well, I think we've made a consistent effort over the last few years to bring down various expenses. As you know, we've done the restructuring of the OPEB trust fund by moving the canals into that, as well as doing Medicare Advantage. That has provided significant expense savings to the tune of $30 million to $40 million a year, as well as other things in terms of how costs are being allocated and recovered, or how costs are potentially charged to, say, capital projects. So those have been efficiencies, and then just other cost efficiencies, working together with Rob Piasek and his team in IT. We've had a joint effort where we've engaged consultants to come in and look at all of our spending around IT, look at bills on telephone networks and things like that, to see if, where we might have opportunities to consolidate and find efficiencies there. We're already seeing some benefits from that work. So I appreciate all the work that Rob and his team have been doing to support that effort. And then, as you know, we came out of the pandemic, and that really gave us an opportunity to reassess other expenses along the way as well, such as just travel and conferences, seminars. Well, those are all important. We've done those, but we've tried to really make sure that that doesn't grow too far out of, let's say, control. Our wages have remained, pretty stable. As you see, we've also recently entered into a contract with the unions that is incorporated into these numbers, but I think that was a fair contract for both the authority and the members of those unions. So we think that at least we have certainty on that for the next few years, which is going to be put into the plan as well. So having more certainty throughout the plan is really what we've been striving for here. There are certain costs that are beyond our control, as I've been talking about, the pension expense, which is driven by how well the stock market does. That's going to have an impact on us next year. So we provided for that as well. But overall, we're seeing a good control over expenses, working with Joe Kessler and his team, and he's given people very tight targets. The things we've been able to do at the Flynn plant last year by having NYPA come in and pay us to keep that plant running, and they pay for some of the costs now for that plant. That's actually reduced costs this year to the tune of about, I don't know, $12–14 million. So all of those little things kind of add up to offset those increases, so that the net of all of that is very manageable. And that's really the key to when we look at the plan, is that we have revenues increasing at a rate greater than our expenses are increasing. And that's why we see a greater increased margin, and that greater increased margin allows us to finance all those capital investments and those capital projects to achieve the Vision 2030 goals and the goals of the state, whether it's building out transmission or the EV network, or any of the maintaining the value of our hydro assets. All of that is driven by the cash that we're generating from our business and reinvesting into those capital assets.
Thanks.
And as we were just mentioning on the Vision 2030, you can see here is that, when we put together our capital plan, as well as our budget, we're very mindful of making sure that we're providing the resources necessary to achieve these outcomes, and that we align the strategy with our allocation of resources. And we're also allocating resources to mitigate various risks as well. So trying to make sure that we're always keeping those things in line and seeing that connection of both all of our financial resources, our human resources, our human capital, and all of that is helping to drive all of those outcomes. So we try to stay focused on that. Next slide, please. As I mentioned before, so when we look at the 4-year plan, we do see numbers that are slightly elevated from what our plan was this time last year. And what that's enabling us to do is actually, close some of the gap we would have had in our forecasting for our capital commitments over 10 years. So it's allowing us to really meet all these obligations that we've made to the state as well as to ourselves to achieve those outcomes. So whether it's helping to fund the next gen Niagara or build out transmission as we're doing, and as well as pay for the reimagined canals program, and also support energy efficiency and other things on our customer side. While those are paid for, we still require resources to enable us to execute on those projects. Next slide. And this is the 4-year look. And as I mentioned before, what you can really see here is that when we say EBITDA, and we look at that, that's really when we look at talk to the rating agencies in terms of maintaining our AA credit rating. So it's all about being able to make those investments in the capital projects and generate what we call funds available for debt service. So in order to maintain our AA rating, we have to maintain at least a 2.0 fixed charge coverage ratio in the view of the rating agency. So we really have to generate twice the amount of cash that it requires us to serve as debt service. Some of that cash is pay-as-you-go capital, but it all goes towards paying for these capital investments. And as you know, we've become a much more capital-intensive organization because building out the grid of the future is going to require significant investment and build out of transmission in order to enable any of the renewables to get into the system. Next slide. And this just shows the outlook on both prices and hydro flow. So certainly, one of the more uncontrollable things we have today, we'll look to see what we can do. As we talked in other meetings about insuring against the risk of that, but it's really hydro generation and what is that flow. So that can fluctuate from year to year, and you can see that fluctuation. And as we show on the right side, that is anything as much as a half a terawatt of change in hydro generation or hydro flow could mean a $20 million shift in net income. So something we have to be mindful of. Less water, less revenue, basically. So we have to always be mindful of that. And as you know, the prices have been elevated in 2022 significantly. And while they will remain high, they are coming down. So that's also reflected in the outlook in the out years, is that we've benefited this year from the higher prices, certainly in the merchant portfolio. But as we look out, we won't be able to stay at that level. It'll come down. And we also have to be prepared if it comes down even more. And that's why we do have this hedging program that we just discussed, so that we manage that downside risk, so that we're not caught in a situation where we've made commitments that we can't fulfill. Next slide, please. This breaks it down by business area or profit center area, giving the hydro assets, the fossil assets, transmission assets. We have HTP and canals, excuse me, which are not profitable today. HTP, we hope that will be a day when maybe that does turn profitable, but we're still working at that. And we also spoke about canals and how we're investing in reimagine and fortifying the canals so that we can also bring those costs down over time. Next slide. And one of the benefits we do have to offset the volatility of the merchant revenue prices is the growing steady increase in transmission revenues. This is a much more stable form of revenue that we can count on and calculate and forecast, that helps to offset that volatility we could have in the energy prices. So this is why the transmission business is a great business for us to pursue from a financial standpoint, but also in terms of its strategic alignment for the state and meeting all of those goals. So it's an area where we're accomplishing great things for the state. It's a good source of growing revenue for NYPA, and it helps reduce the volatility otherwise in the forecast. Next slide. So the major investments, are in this plan around those major transmission projects, particularly Smart Path Connect, which is going to be the largest project that we'll be funding in 2023. But we also have investments in our energy efficiency programs, which again, we lay out the money, but it gets repaid for by our customers, and helping them achieve their goals to reduce their carbon footprint, and as well as delivering and maintaining a state of good repair of our assets, which are very important. We also have to be mindful of maintaining that state of good repair so that we can avoid major expenses should we not, or maintain our assets to that level of operating capability so that we are not in a position where they fail and require even a greater investment down the road. And in this plan, 90% of the money in this capital plan are for projects that have already been approved and are continuation, and 90% of them can be broken down into the large 20 big rock projects we'll show later in the slides. Next slide, please. This is just another way of breaking down that capital investment between the transmission, generation, our headquarters investments, and canals, which is in the green. That canals investment includes both the expectation of what NYPA will contribute, as well as our efforts to obtain federal and other sources of funding, which will enable us to do those. So it includes an assumption around that. In the top right are the energy efficiency projects, which I mentioned before, are paid for by our customers, but are still significant investments, require significant resources in the organization to support those programs. We also have built into the plan in the out years things such as the Propel, should that we end up being successful in being selected for that project. So in the event that that does happen, that is already built into these assumptions. Next. And this is just
But
trying.
those are ones we have already built up. You've only included projects that we've actively bid on. Right?
Yes.
Yeah.
There are some monies in the out years for other potential, say a property acquisition or something, should that come along. But the only projects that we've actually funded are those that we're actively bidding on. This just shows some of the alignment between the capital spending and our Vision 2030 strategy to ensure that we're putting money towards all of the major themes here. Just showing it how it lines up with those on the left in terms of preserve hydropower, lead transmission, the energy efficiency projects, canals, and on the right are investments in those other foundational pillars, such as our digitization investments in the IT area, as well as our resilience efforts to fortify the authority, as well as resource allocation. And the 123 million of diversity, equity, and inclusion really represents the amount of money when we're talking about all these capital spends and all the project spending we do in the authority. We have specific targets to allocate some of that money towards MWBE vendors and suppliers, whether it be as a prime or as a subcontractor. We have goals that we set, and this is our goal to how much money we're going to spend on MWBEs throughout the plan.
So one minor point that it always confuses me when I see, and I've raised it before, the ESG, it's a small bucket, but it just confuses me when I see it there, considering ESG overlaps with a number of these different areas. And so it's not clear to me why we categorize those few things as ESG. I mean, you've got decarbonization efforts are part of ESG, or DE&I efforts are part of ESG. So why do we do that? It just confuses me when I see this small bucket around ESG as opposed to an umbrella for a lot of the things that we do.
I mean, we can break it up that way as well, if you'd rather see that.
Well, just because it doesn't, it's broader than just these. Like,
right. So when we look and we score projects, we try to see where are they aligned strategically. So if they line up with a specific pillar, say, preserve hydropower or lead transmission or customers in the state, it goes into those. But if it doesn't fit neatly in
It's a
those, but
catch-all
it's
bucket.
still,
It's a
yeah, it's catch-all bucket. But it still is, you know,
But these
under
are
the
all
ESG.
decarbonization
Correct.
things. So
Correct.
maybe we just need a broader decarbonization bucket
Yep.
because
We can
ESG
easily
could
do
be
that.
over top of a lot of these different things. Yeah. Okay.
Yeah, I mean, if you really look at the plan, right? So as we present it to bond investors and others, you know, we really do say that our investments are really ESG
Yeah.
overarching, right? All the things we're doing throughout the authority is with an ESG focus around it.
Yeah, exactly. Great. Thanks.
Next slide, please. And this is just looking, I mean, the interesting takeaway here is just that while state of good repair has always been the sort of the leading area in which we or foundational area that we build the capital plan around, because we believe that has to come first as a priority. But you do see, though, that over time, that growth is starting to, exceed because we have these opportunities, because we're winning these projects, because we're making these investments into, expanding and renewing the grid of the future. So it's just showing a little bit of that transformation that's going on over time. Next. And this is what I was saying before about those, 20 or so large big rock projects, obviously the biggest being the Smart Path Connect, but all the other big projects that are making up this capital plan, and the balance of it is a lot of smaller other projects, but really the bulk of it is summed up in these projects here that you've all seen and we report on a regular basis. Next slide. Again, just trying to bucketize some of these projects as to where they are all sitting in terms of resiliency, R&D, digitization, analytics, decarbonizing our customers. So just another way of slicing and dicing it. We do pull out also as we're making a push, Justin has mentioned in terms of making a focus going forward around innovation. We've also sort of pulled out and highlighted those projects that represent, in our view, innovation this year in terms of that investment of about $80 million, and trying to put a spotlight on that as well. Next. And this is just more detail on some of the projects in the outer years as well that we're getting to get started on and we're looking at, but really just a breakdown of what they are and what represents new for this year, which is plus 72 million out of the 906 million. But as you can see, 92% of it, or 834 million of it, is really all continuing work that we've begun in the prior year. So it's just continuing to build out some of these projects that we've been discussing for a while. Next. And again, this is a report that you may have seen, or you do see on a regular basis, just giving a status of those projects, where they are in terms of on budget, on plan, on cost, on schedule. Most of those are in green. The ones in red we've been discussing. And as we've highlighted here, that Smart Path Connect is now higher than was originally estimated. The project is still on track and will continue to deliver that additional benefits above the cost and multiples, and the value proposition there still remains going forward. Next slide, please. All these are green with the exception of the Zone Z battery storage, and we've discussed some of the challenges that have been in that area, but we do see some of that accelerating as we go forward, certainly next year, and also looking at some of the opportunities we may have in terms of getting additional federal funding for different storage projects. So we see an opportunity going forward on that particular project. Next slide, please.
I guess the only one question that I had on the two red items that weren't necessarily due to a cost, but scheduling, which is the efficiency and the storage issue. So so I guess we're assuming the delay won't cost us anymore because it seems like we still expect to deliver at the cost that we had forecast, but just a little later than what we do.
Yes,
So that doesn't convert into dollars, that delay. Okay.
not at this point, no.
Great.
Okay, so any other questions on that? I think before we go into the next item, I think we have to make a recommendation.
Sorry. Do we?
Or do
Oh,
we
yeah.
do that at the end?
No, we do. So this is for the filing of the preliminary 2023 through 2026 financial plan. I'll ask for a motion to recommend this item to the full board for adoption.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thank you, Adam. And then, okay, next
So the
item.
next item is, because this is the last opportunity we'll have before the new year would kick in, so we want to release the first quarter of funds related to the canals. Next slide, please. And this is the release we set at $27 million, representing 1/4 of the canals budget for the next year. We set it conservative, but as we mentioned, we're looking at things between the preliminary and the final. We believe this number will not be exceeded, so I think it's safe to approve at this level.
Any questions, comments? There being none, I'll ask for a motion to recommend this item as well to the full board for adoption.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thanks. And the next item, Adam.
This is the release of funds in support of the residential consumer discount program connected with Recharge New York Power Program. Next slide. As you recall, this program was created in March 2011, and the funding level has been $30 million a year since 2017. Are there any other questions on this, that we can release this money without it pairing our 2.0 or any other requirements that is set by the board in order to make this money available for recharge?
And I guess my only question is, do we still think this amount is sufficient for what we try to do with this program?
As of this point, I would say yes, but I would see if there's any
Do
questions.
we have
Pete,
discretion
do you
to
wanna-
increase it?
We have discretion as deemed feasible and advisable by the Board of Trustees to not issue this. It does not really provide meaningful benefits on bills. They are very small dollar amounts.
So that's the answer to my question.
So again, this can be set at whatever value the board deems feasible. This is to support, residential consumers, across the state. In the end, it's part of, NYPA's attempt at supporting, the general pocketbooks of all residential consumers, just the same as the tariff structure that we have, for our recharge customers. So again, this is touching on residential consumers, which we typically are not serving, as directly, although we do through munis and co-ops. It's one of the numbers of ways that we're supporting the state in different facets. Happy to provide more detail on it.
Yeah,
Again,
I
it's-
just understand. It's been since 2017.
Yeah.
A lot has happened for residents since
Yes.
2017. So it's just a question of
Yeah.
whether or not we still think this amount of 30 million is sufficient to accomplish what we have set out to accomplish and assist residents in the way that we wanted to.
I think it's ripe for at least a closer look, and maybe what we could do is come back to you between now and the full board meeting
Yeah,
with
that'd
more
be great.
detail around it and a recommendation either up or down or to stay at 30.
Good. Okay, any other questions? If not, I'll also entertain a motion to recommend this item to the full board for adoption.
So moved.
Second.
Moved and
Yes,
seconded.
pending.
All in favor, say aye.
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 So
Any
that would be
opposed?
I as a minimum, Tracy, pending further review.
Yes, exactly. Yes.
Okay.
Great, thanks, Chair. Okay, all in favor? I think I heard ayes, no opposed, motion carries. Thank you. And then the final item that you have, Adam?
Is the release of funds for the initial capitalization of the NYPA captive insurance company. Next slide, please. So as you recall, we were fortunate this year, the 3 years of trying to get the legislature to approve and the governor signed into law, to allow NYPA to form a captive as a subsidiary and file with the Department of Financial Services, which is underway right now to get approval. And part of that regulatory approval is to ensure that we have the initial capital funding available for the captive insurance company. And we've been discussing with them that initial amount would be $100 million. So we're recommending the capitalization of that. This is not an expense for the authority. It's basically an investment or a capitalization of a subsidiary, but it'll allow us to achieve the various coverages we're looking to do now and in the future, particularly around accessing the federal terrorist risk insurance pool, which we are looking to do at the level of $500 million. So we would need $100 million to secure that. And this is one of the commitments we did make to the legislature in our discussions with them, that this would be the first thing that we would go after, because this is essential, which is really the differentiator for us in terms of being able to do this versus not if we didn't have the captive. If there's any other questions on this, happy to entertain that.
Any other questions on the captive insurance company capitalization? No. If no questions, I'll entertain a motion to recommend this item to the full board for adoption.
So
So
moved.
moved. Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thank you, Adam.
Sure, thank you.
We'll now turn it over to Eric, Director of Labor Relations, to present the next item on our collective bargaining agreement.
Good morning,
Thank you for joining
trustees and
us.
NYPA staff members. Can you guys hear me okay?
Yes.
Yes.
Okay. The tentative memorandum of understanding referred to is between the authority and the local unions, 2032 and 2104 of the International Brotherhood of Electrical Workers, which is the IBEW. The current agreement expired on March 31st, 2022. The term of the new agreement, if approved, will have an effective date of April 1st, 2022, and will expire on July 31st, 2027. It's a 64-month agreement. It covers 550 represented employees at the authority's Blenheim Gilboa Pump Storage Project, which is BG, Frederick R. Clark Energy Center, which is Clark, CEC, Niagara Power Project, and the St. Lawrence FDR Power Project. Over the last year or so, the parties engaged in extensive negotiations, and we reached a tentative memorandum of understanding on October 7th, 2022. It was ratified by the union membership on October 27th, 2022. The new agreement overall provides for general wage increases averaging about 3.2% a year. The authority gained important modifications in the health coverage for post-Medicare retirees, as well as a significant reduction in wage costs for the non-craft employees. There were other enhancements and modifications that were agreed upon and referred to in the slide. That covered wages, benefits, retiree medical, per diem, other enhancements, and then holidays. And as Adam stated, the cost of the contract will be reflected in the 2023 budget and the 2023-2026 financial plan. Both parties were satisfied with the tentative agreement, and we are seeking approval to send to the full board.
So I looked at it, lots of good things. We're all competing for labor here, and across every industry. So it looks like very successful negotiation. So congratulations to the team. Any other questions from the committee on this?
What is the annual?
Dennis,
impact,
would you
dollar
agree?
impact?
Sorry. Sorry, Chair. Go ahead. Go again.
What does this translate to in terms of an annual dollar impact on us? I know you said, I know it's included in the plan, but just looking to quantify. What's the incremental cost to us as a result of this? Or you can come back to me, that's fine.
Yeah, we have a.
Chairman, I'll send you a schedule. It increases every year, so you have to factor it as it goes on over the next few years. But I would just say it's, it's really immaterial in terms of the overall financial plan and based on how we do model our forecasting and our plans. So it's within the ranges that we've always been providing for, but I can give you the specific breakdowns of the year by year increases and we'll reflect that, in the future as well.
Great. If no other questions, Dennis, I'll entertain a motion from you.
I have one question. Just was the contract you said was tentatively agreed upon, is it out for ratification or has it been ratified by the membership?
It's been ratified by the membership.
Okay. Okay.
Yep.
Pretty
To
hard
answer
for
your
this board to-
question,
Go ahead.
I have the information for you.
Go ahead, Dennis.
I just, if it's been ratified by the membership, I hope the board would approve it then.
So moved.
And then I think Adam has found the
Second.
number that you were asking for.
Yeah, so
Okay.
the cost starts at 1.9 million for 22. And it goes to 5 million, then 7 million, increasing by 2 million each year up to 13 million by the year 2027, 28.
Okay, thank you. Yeah, Dennis, that's why I specifically thought you might like to make the motion for this.
Make the motion to accept this tentative agreement, this ratification.
Can I get a second?
I'll
Second,
second it.
me, go ahead.
All in favor, say aye.
Aye.
Thank you, Tracy.
Any opposed? You're welcome. Motion carries. Thank you. All right, last item, Keith, over to you.
Morning, Chairman Kibben, NYPA trustees, interim president, CEO Driscoll, and the executive team. This item covers an industrial incentive award, also known as an IIA. IIAs are funded through the net revenues of the sale of expansion power, which is sourced from the Niagara project. That's 250 megawatts in total. In 2010, the Erie Canal Harbor Development Corporation received an IIA with annual payments from NYPA for $3.7 million annually, scheduled through 2029. NYPA has already dispersed 44.4 million, and there is approximately 29.6 million left to be dispersed. ECHDC provides NYPA with an annual economic development plan of where the funds are spent to support economic development projects in accordance with the IIA agreement. The project or projects aim to revitalize Buffalo's inner harbor, creating waterfront vitality. The projects support residential, commercial, retail, and cultural elements in downtown Buffalo, also known as the Canal Side Development Project. ECHDC has requested NYPA to accelerate the balance of payments under this agreement to design and construction projects already underway. In this case, we would buy them out of the balance of the 2010 agreement based on a 4.75% discount rate with a lump sum payment of $27.1 million. Examples of the projects are indicated on the right on the next slide, please. And I'd be happy to take any of your questions.
Have we done a similar type of advancement before? Yeah.
Not under the industrial incentive awards that I'm aware of.
We have done it on the relicensing.
On the relicensing, yes.
Yeah, but not on the IIA.
Any other questions for Keith? I mean, it's an obligation. We're just moving it forward.
Advancing it,
Yeah.
yes.
And we're getting a discount in terms of the present value.
Okay, great.
I'm happy to move it.
Great, moved. Can I get a second?
Second,
All in favor, say aye.
aye,
Aye.
Any opposed? Motion carries. It will be sent to the full board. Thank you,
Thank you.
Keith. The consent agenda is before the committee for adoption. I'll ask for a motion to adopt the consent agenda if there are no questions or concerns.
so moved.
I think I heard a second in there. All in favor, say aye.
Aye,
Aye.
Aye.
Any opposed? Motion carries. The date of the next joint finance and risk committee meeting is to be determined. I'll ask for a motion to close the meeting.
so moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thank you, committee members. Thank you, everyone who participated online, and thank you to all the team around the table.
Thank you.
Good discussion.